Hello and welcome to the Lolly Investor Programme. This week I'm going to explain some more investment jargon with the aim of getting you to think about what kind of investor you are. At the risk of getting too philosophical, it's important to know who you are if you're going to work out where you're going. In investment, as in many areas of life, concepts are often presented in a binary black or white sort of way. However, things are rarely that simple. Let's look at a few examples. The stock market wouldn't work without buyers on the one hand and sellers on the other. Bulls are buyers. They're optimistic investors who charge into every opportunity. They always see a positive in a situation and they drive up share prices and the stock market. Bears are the opposites. They're sellers. Scared of the world, they hunker down in their caves and wait until the stock market winter they think is outside passes. Of course, no one is a bull or a bear all the time. In fact, these words don't describe investors, they describe investor emotion. And emotion, while positive elsewhere, is the enemy of good investing. The most successful investors are calm, analytical individuals prepared to stand out from the crowd and do the opposite of what others are doing. They don't panic. When others are selling, they're buying. When others are buying, they're selling. That way, they buy when prices are low and sell when prices are high. And that's the way to make money in investing. Other common opposites in investing are active versus passive, growth versus value, and growth versus income. An active investor is one who thinks that he or she is so good at picking investments that they can beat the stock market return. However, over time and after costs, consistently good stock picking is difficult to achieve. That's why some investors prefer a passive approach. Instead of trying to pick stock market winners, they just try to track a stock market index like the FTSE All-Share by buying into all the companies on that index. So should you go active or passive? It's a huge debate in investment. Which way you go is up to you. On the one hand, actively managed funds offer the prospect of the very best long-term financial returns. On the other hand, only a minority actually achieve this. And while funds' past performance gives a clue, it does not tell you which funds will do best in future. Turning to passive funds, on the one hand, they offer a cost-efficient way of getting close to the stock market return, which experts agree provides the best long-term way of growing your money. On the other hand, being a passive investor can be an uncomfortable ride. When markets crash, as they do sometimes, so do passive funds. At least with an active fund, there's a chance the manager may see trouble coming and get out the market. Now, I've presented active and passive as if they were opposites. In fact, you can combine them to get the best of both worlds. For example, you could invest the core of your savings in passive tracker funds and put the rest in one or more active funds run by an experienced manager. There are two main styles of investing, value and growth. Value investors look for shares trading below the intrinsic value of their companies. In the words of Ben Graham, who first wrote about value investing, such an approach offers a margin of safety. After all, there should be a limit to how far such shares in overlooked companies can fall if they're already a bit of a bargain. Growth investing does the opposite. It looks for companies whose profits are growing quickly and doesn't worry too much about the price, which can be high, as often these companies are well known. In practice, value and growth investing are not opposites. There are times when both value investors and growth investors like the same companies, which is why some investors have come up with the phrase growth at a reasonable price to try and capture the best of both approaches. Last, we come to growth and income. This is another important distinction, but don't lose any sleep on it. Growth investors tend to be younger people who don't need the income today that their investments produce. Instead, they reinvest that income so as to maximize the rate at which their money is growing. Ultimately, though, we're all income investors. When we retire, we need all our savings to generate an income that we can live on. The two ways of doing that are either to buy an annuity from an insurance company with your savings, or to manage your savings in such a way as they produce a high income but without taking silly risks with your capital. Talking of risks, attitude to risk is the real way to tell investors apart, so I will turn to that in my video next week.